Don't be shocked when this happens to gold. And before we dive in, all I ask for return for all the work that goes into making a video like this, that you hit that like button and don't forget to subscribe, because every time you do that, YouTube pushes this video out to more people, and that in turn helps us prepare more people for what's actually happening right now. And what is happening is a convergence of forces so powerful and so perfectly aligned that if you understand them, you will not be surprised when gold does what I believe it's about to do. The United States is currently carrying more than $38 trillion in debt, and by every historical precedent, the current system should already be under extreme stress, and yet the country keeps operating as if nothing is wrong. Financial markets keep mostly hitting all-time highs while the real economy is deteriorating underneath, and it's precisely that disconnect that's building the case for gold in a way that I've not seen in years. So stay with me, because by the end of this video, you're going to understand exactly why gold is on track for its 8th consecutive green month, why it's coasting to new multi-week highs, why the longest streak on record in the metals market is not an accident, and why the smart money has already made its move while most people are still staring at tech stocks wondering what happened. This video is for educational purposes only, and nothing in it guarantees profits or future performance. So with that said, let's get into it. The first thing you need to understand is that gold does not go up because people love gold. Gold goes up because people are afraid. And right now there's a lot to be afraid of, and the fear is not irrational. It's rooted in a series of concrete systemic failures that are happening simultaneously and feeding off each other in ways that are going to keep pressure on risk assets and keep capital flowing into safe havens for a long time to come. Let's start with the tariff situation, because it's the most immediate driver of uncertainty in this market right now. The Supreme Court struck down Trump's IEEPA tariff authority, ruling that the International Emergency Economic Powers Act was designed for genuine extraordinary threats and not for long-standing trade agreements that have been in place for decades. And within 24 hours of that ruling, the administration pivoted to a 15% global tariff using different legal mechanisms. Section 122 of the Trade Act of 1974, which caps tariff authority to 150 days without congressional approval, and the plan changed from 10% to 15% overnight. The EU immediately froze ratification of its trade deal with the US, and the UK and Australia said they were weighing their options, and India postponed talks aiming at finalizing its agreement with the White House. Trump responded by saying any country that wants to play games will face higher tariffs and worse. So what you now have is a global trade situation with no legal certainty, no durable framework, a 150-day clock ticking towards expiration in July, right in the middle of midterm season, and every major trading partner on Earth wondering whether any deal signed with this administration is actually worth the paper it's printed on. And what is uncertainty of that magnitude do to capital? It drives it out of risk assets and into things that hold value, regardless of what any government does, things like gold. In times like these, the best way to secure and maintain your retirement is to maintain a balanced portfolio that can ride through this economic chaos. And with that in mind, I've developed a list of the best 6 stocks to own in 2026 that you can download for free at free.stockscommunity.com. That link is in the description, and if you're actively managing your stock portfolio, head over to stockscommunity.com to learn how I buy and sell stocks at the right time. I'm currently offering a completely free 10-minute training on how I spot stocks before they go up. This is the same training that one of our members watched and went on to make thousands of dollars in a day. You can view it 100% free at the link in the description below. And as always, nothing in this video is financial advice. Do your own research. Now let's layer in the second force driving gold higher, because the tariff chaos is actually the least alarming thing happening right now when you look at the full tariff picture. Underneath the surface of this market, there's a credit system that's quietly cracking, and most people have no idea it's happening. The private credit sector, which has grown by a factor of 5 since the global financial crisis and now sits at an estimated $3 trillion in known assets, with potentially tens of trillions more in non-bank lending that we cannot fully see, is showing serious signs of stress. And the way you can see it is by just watching stock prices of the major credit firms, because those prices function as a confidence meter. When they go up, it means investors believe the loans are safe and the borrowers are paying on time. And when they go down, it means investors are worried that the borrowers are not going to make their payments and that the economy underneath is shakier than it looks. And right now, those prices are going down hard. Blackstone, the world's largest alternative asset manager with over $1 trillion on its books, just broke to new 52-week lows. The Carlyle Group broke to its lowest level in over 30 weeks. Blue Owl is down over 61% from its peak and sitting near 3-year lows. And what this is telling you is that the businesses that borrowed money from these private credit funds are beginning to struggle. And if you think about who holds exposure to private credit, you're talking about pension funds, insurance companies, sovereign wealth funds, collectively trillions of dollars of institutional capital, and the millions of everyday people whose retirement savings are tied to those institutions. And there's an ETF called BKLN, the Invesco Senior Loan ETF, which measures credit risk from lenders, and it's specifically sensitive to the creditworthiness of the lending market. BKLN has been quietly trending down for months and is now beginning to crash. And what that sensitive signal is telling you is that something is beginning to blow up in the background. Something is beginning to fail in the shadows. And we do not yet know the full entanglements of whatever a firm or entity is under stress. And as Warren Buffett said, when the tide goes out, we learn who's been swimming naked. And right now, there are a lot of signs that some very large swimmers are about to get exposed. And speaking of Warren Buffett, the Oracle of Omaha is currently sitting on $380 billion of cash and short-term treasury bills at Berkshire Hathaway, up sharply from prior years. And Berkshire also has been cutting positions in Apple, Amazon, and Bank of America. And when the most respected long-term investor in the world is holding more cash than at any other point in modern history, that is not a coincidence. That is a signal. And what it's signaling is that the people who've been doing this the longest and the best believe that asset prices are dangerously elevated and that there's more risk in this market than the headline numbers suggest. And gold is the direct beneficiary of that kind of institutional caution. Now, let's talk about the AI disruption layer, because this is the third force amplifying the gold narrative, and it's one that most people are only beginning to understand. The market this week got hit by an essay from a financial research firm that described a scenario they called Ghost GDP, where businesses deploy AI at scale to cut labor costs. Productivity metrics soar on paper, but the gains do not circulate through the real economy because they flow into data centers rather than into worker paychecks. And a negative feedback loop emerges where companies lay off workers, workers spend less, consumer demand weakens, companies invest even more in AI to protect margins and repeat. And the stock market reaction to this essay was immediate and severe. ServiceNow fell almost 4.5%. Salesforce, MasterCard, Visa, American Express, DoorDash all got hit. IBM had its single biggest day drop since the 2020 crash after Anthropic announced that Claude can streamline COBOL code that powers 95% of US ATM transactions. CrowdStrike fell over 10% after Anthropic's Claude Code security announcement. And what this AI disruption wave is doing to the market is creating a new category of uncertainty on top of the tariff uncertainty. When you stack those two things together and add the private credit stress, you get a private and public market where, in the public markets, the VIX's been elevated for weeks, where hedge funds sold stocks at the fastest pace since the Liberation Day crash, with net selling running 1.4 standard deviations below normal, where Bitcoin's fallen over 27% year to date and Ethereum over 38%, where technology, consumer discretionary, and financials are the worst performing sectors of 2026, and where the only sectors actually performing well are the ones that investors flee to when they're scared. Energy up 23%, gold and silver up 20%, materials up 15%, consumer staples up 15%, utilities, real estate, and industrials all pushing higher. In this rotation, it's not random. It's capital doing exactly what capital does, and it senses systemic risk. It moves from things that could be disrupted or defaulted on into things that are real, tangible, and needed regardless of what any algorithm or any trade policy does. And here's where the gold story gets really interesting, because gold is not just benefiting from fear right now. It's benefiting from the specific kind of fear that's the hardest to resolve quickly. Tariff fear can in theory be resolved by a court ruling or a political deal. Tech disruption fear can in theory be resolved by earnings beats or policy responses like NVIDIA earnings coming up. But the kind of fear that comes from a credit system quietly cracking under the surface, from $38 trillion in sovereign debt with no credible path to reduction, from a Fed that's already pumped $90 billion into markets since February just to keep things stable and has no plans of slowing down. From inflation, it remains sticky and is not going away even as the Federal Reserve is desperate to cut rates. That kind of fear doesn't resolve on a Tuesday because someone posts good earnings guidance. That kind of fear builds slowly and then moves fast, and gold is the asset that gets positioned in advance of the fast part. And for people watching the private credit signals, watching the BKLN meltdown, watching Blackstone hit 52-week lows, watching Buffett stock go into cash, these people are already in gold. Now, the question for everyone else is whether they're going to be early or late to the same conclusion. And the sector performance data for 2026 makes this case visually and undeniably. Gold and silver, again, are up 20%, while equal weighted S&P 500 is holding near all-time highs, only because the defensive sectors are pulling their weight. And the market cap weighted S&P is lagging because the concentrated pain is exactly where this concentration of capital was, in the Mag 7 and big tech. And when you peel back the headline index number, what you find is a market that's already voted. And the vote is for safety. The vote is for tangible assets. The vote is for the things that hold value when the confidence meter is falling. And right now, the confidence meter is falling. Now, with NVIDIA earnings coming Wednesday, there's a scenario where a strong beat temporarily lifts sentiment and pulls some capital back into risk assets. And if that happens, you should understand it for what it is, a tactical bounce and a structural rotation, not a reversal of the underlying forces driving gold higher, because none of the things that we've talked about today get resolved by one earnings report. In fact, in NVIDIA's last earnings, you'll recall it went up and then went down. And this tariff framework is still a 150-day emergency measure with no durable legal backing. The private credit stress is still building. The AI disruption wave is accelerating as of 10:40 a.m. on Tuesday the 24th. There's sticky inflation, slowing economy, and $38 trillion in debt. It doesn't disappear because Jensen Huang beats revenue estimates by $2 billion. So the structural case for gold is intact regardless of what happens Wednesday. And the people who understand are the ones who will not be shocked when gold continues doing exactly what it's been doing. So, what did I miss in this one? What would you push back on? Let me know in the comments. And if you're managing your portfolio independently and want to know how I spot stocks before they go up, watch my completely free training at stockscommunity.com, where I go over the same methods I teach my students on how to find the best stocks, spending just 10 minutes really in front of their computers a day. If you already have a portfolio and want to make sure you're in the best stocks in the market, download my best 6 stocks to own in 2026 for free at, and this site should be up, free.stockscommunity.com. If you found this information valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it, because the people who prepare themselves and stay one step ahead of the everyday person will always come out ahead in the long run.